Good morning. The tape today confirms a definitive fracturing of the Magnificent Seven trade. While the broader market indices test record highs, we are observing a clinical divergence in how institutional capital is treating the AI CapEx supercycle. On one side of the ledger, we have Apple, the sole survivor of the recent volatility, reclaiming its position as a $4.06 trillion heavyweight. By maintaining an asset-light AI strategy with a projected 2026 CapEx of just $14 billion, Apple has avoided the reality wall currently hitting the hyperscalers. Conversely, we are monitoring the continued fallout from Amazon's $200 billion spending shock, which has triggered an 8 to 10% contraction in its equity value as the market reprices the company's shrinking free cash flow. The narrative has shifted. It is no longer about who spends the most, but who can finance the build-out without eroding their sovereign-level credit profile. The primary catalyst for today's action is Alphabet's aggressive entry into the debt markets. Alphabet has upscaled its U.S. high-grade bond issuance to $20 billion, up from an initial $15 billion, following a surge in institutional demand. This capital is earmarked to fund a staggering $185 billion CapEx midpoint for 2026. Nearly double its 2025 spend. To put this in perspective, the combined 2026 CapEx for the big five hyperscalers, Amazon, Alphabet, Microsoft, Meta, and Oracle, is now projected to exceed $660 billion. Amazon leads this pack with a $200 billion gambit, an outlay that exceeds the entire annual investment budget of the U.S. energy sector. While AWS growth remains robust at 24%, the monetization gap is widening. TTM free cash flow for Amazon has contracted to $11.2 billion, a historic low relative to its $2.38 trillion market cap. We are witnessing a fundamental transition. Tech companies are now being valued as industrial-scale infrastructure operators, and the cost of entry is rising. The most significant institutional signal today is Alphabet's issuance of a 100-year century bond in the UK market. This is a rare, sovereign-level maneuver not seen in the tech sector for nearly 3 decades. By securing capital for the next century, Alphabet is signaling that AI infrastructure is not a cyclical trend but a permanent utility. Our 5-year outlook suggests an infrastructure inversion. As software efficiency improves, the bottleneck for AI growth has shifted from model parameters to the physical availability of power and silicon. Alphabet's acquisition of the Intersect energy firm and its long-term solar packs in Texas confirm that the winners of this decade will be those who control the hard tech, the data centers, the proprietary TPUs, and the 24/7 carbon-free energy grid. We expect the market to continue rewarding companies like NVIDIA, which captures 90% of this accelerator spend, and Alphabet, which is successfully duration matching its debt to the lifespan of the AI era. The era of pure-play software growth is over. The era of the industrial AI giant has begun. That is the intelligence for the morning session. For deeper granularity on individual Mag 7 credit spreads and the specific ROIC timelines for these CapEx outlays, hit the subscribe button for our daily notifications. We will update our models as the macro volatility settles. See you at the opening bell.